Welcome back to the Capital Compounder Show. This is episode 11, and today we have a special guest. With us today is Mathieu Martin. He is the portfolio manager of the Microcap Fund at Rivemont, and you're calling us from, is it Montreal you're living at right now, Mathieu?
Yeah, in the neighborhood of Montreal. I'm on the South Shore, but pretty close to Montreal.
Wonderful. It's one of my favorite cities in the whole world. I absolutely love Montreal. Tell us about the poster behind you. That's Howard Marks, is that right?
Yeah, that's Howard Marks, and the quote is actually let me read it because I don't see
Yeah.
it. It's to be a disciplined investor, you have to be willing to stand by and watch other people make money on things that you passed on. Which I love. I actually won it. It was a giveaway on Twitter. It's handmade. It's all wood in wood, out of wood. It's a beautiful piece, and Howard Marks is one of my favorite investors. One of the first investing books I read like 10 years ago was The Most Important Thing by Howard Marks, and it really shaped my thinking about understanding the market cycles, the psychology of investors, and also how to think about risk and downside protection. So yeah, I love Howard Marks.
It's a great book to read. I've read it as well, and as soon as an interview with him pops up on YouTube, I just click watch.
Yeah,
I
me
click
too.
play. And the quote basically was the theme of your newsletter you just issued today that I finished reading, which was awesome, by the way, which is the top 5 reasons to pass on an opportunity. Can you tell us what are the top 5 reasons why investors should just basically say no to a microcap?
Yeah, for sure. So, basically the article I wrote was about, the Canadian microcap universe is pretty large. There are over 2,800 companies that are below $300 million market cap. And it's the least efficient place as you would expect, since there's not a lot of liquidity. You don't see a lot of institutions or professionals playing in that area. So it's a large universe where very few people look at. And for me, I'm the portfolio manager of a microcap fund. I have one analyst. We do this full time, but it's still a lot of opportunities to look at for just two people. So what we try to do is get to a no as soon as possible. When we look at something new, we try to reject it right away and make sure we spend our time wisely on the right opportunities. So I just shared the top 5 reasons why I pass quickly on something. So the first one was a lack of profitability. There are so many unprofitable companies in microcaps. Companies are so early stage, so it's normal. Like I don't expect it any other way. But for me, I think if you find a company that has at least a couple quarters of profitability under their belt, it reduces the risk a lot. Because it shows that the company can stand on its own. The second thing was I'm looking for revenue growth. If you're a microcap company, especially below 100 million in market cap, there's no way you get discovered by the institutions and you get better liquidity, multiple expansion, analyst coverage, all those good things if you don't grow. So for me, I'm looking for companies that can grow at least 20% a year. Like the example I gave, like if you're a $15 million revenue company growing 5% a year, like you're gonna stay a microcap. I'm sorry, but it's gonna be very, very challenging to go beyond 100 million in market cap. Then you have the balance sheet. Anything that has a weak balance sheet, lots of debt or negative working capital, I typically don't touch that because usually they're gonna have to raise capital, and it means more dilution. It's a lack of focus also for management. The fourth thing was a bad management team. So sometimes it's hard to tell because most CEOs are good salespeople, or at least if they're dishonest, they're probably good salespeople to hide that. So you got to be careful. But some hints for me are how much they seem to focus on the short term versus long term. So if they always talk about what they're going to do next quarter instead of over the next 2-3 years, if they seem promotional, they talk a lot about the stock price. They always say that they're so undervalued and that they're going to do more IR, more promotion, things like that. Those are all red flags to me. And then like every time I look at a new company, I also Google the CEO's name and see what comes up. Do they have a shady past or something? It doesn't happen a lot. I don't often find something, but you never know. And the last thing was anything that's commodity related. So I have no expertise predicting macro cycles or predicting the price of gold or any other metals. So I avoid those sectors altogether, and also anything that is what I consider a commoditized product or service, where there are no barriers to entry, no product differentiation in the marketplace. Those companies tend to be, commodity-like businesses. They're price takers. They don't have any pricing power. So I try to avoid that as well. And if you look at these 5 criteria, you probably remove over 90% of the microcap market in Canada. So that's a very efficient way to filter and get to the investable companies, in my opinion.
Absolutely. I think that's your next poster. I think those 5 rules on the wall behind you, right? Because I think a lot of investors, when they look at microcap companies trading below $1 per share, let's say, under 300 million market cap, they think, okay, is this a 20 bagger, a 30 bagger? It's going to go up 50 times. Whereas your disciplined rule set, those 5 rules, say, you know what, stick to the business fundamentals, right? It's not about the lottery ticket. It's about the business, and I think it's important to stay disciplined, right, in microcaps.
Yeah, totally agree. I mean, I've been investing for over 10 years, and I made a lot of mistakes. I invested in a lot of subpar companies over the years, and companies that diluted me over and over again. And you learn some lessons. I mean, looking at the upside is important, but looking at the downside, especially in illiquid microcaps, it's so important as well.
And so let's go back to the beginning. And how you first got interested in the stock market. You started out as, I think you were making money as a poker player, is that right?
Yeah, exactly. I used to be a poker player when I was in my early 20s. I'm gonna turn 35 soon, so it's been a long time ago. But yeah, I used to play poker, and at that point, I had amassed a decent amount of savings. That I was looking to invest somewhere. I didn't go to college. I didn't have any finance background or accounting background. And one of my friends at the time, Philippe Bélanger, he had studied in finance. He was also a poker player, so that's how I got to know him. And he started investing in microcap companies in Canada. And, on a poker trip, someday he told me about his strategy and basically how you could develop an edge in this market, because the inefficiencies, the professionals don't play in this space, things like that. So I quickly understood how there were some similarities with poker, because in poker you try to exploit weaker opponents at your table. In microcaps, like where is the competition less fierce? It's in microcaps, where you invest against quote unquote part-time retail investors for the most part. So I started, investing in a few microcap companies. I started reading books. I would go to conferences. Like, I was a total newbie, but I would go to conferences and meet management teams one-on-one. It's like I didn't know that you couldn't do that, if you will. Like, when you're such a newbie in a space, and I would meet like $100 million market cap company and just ask questions to the CEO. I learned very quickly these first few years just by trial and error, and it took me maybe 2 years to really figure out like my style, my investment philosophy and strategy. And then the first 4 years of investing, I compounded my TFSA at 40% CAGR. So I had some really good years to start, and it really got me hooked on making a living with microcap investing. So I'm not sure if you want to go into Rivemont, but that was kind of the
Absolutely, absolutely. And then you obviously studied for the CFA, and you're now a charter holder.
yeah.
And then you set out to start up shop somewhere, right? You wanted to be a portfolio manager. That was the vision. And I just love how you went about it. So you basically knocked on the door of Rivemont, a Montreal-based money manager who at the time did not invest in microcaps. So tell me about that journey.
Yeah, so well, actually, the funny thing is, Rivemont's president was also I'm a poker player. Like he wasn't playing full time or anything like that, but he was kind of involved a little bit on the Quebec poker scene, and so I knew it. I knew him prior to ever thinking about starting a microcap fund. But so after those first few years where Philip and I had pretty good returns with our personal accounts, we started thinking about pooling some capitals from friends and family to scale the strategy a little bit more. And so our first idea was, let's approach Rivemont because they're already in business. They have all the regulatory hurdles, they've already cleared them. So for us, it was a much easier way to get started. So initially, I mean, Rivemont's president, Martin, he was very open to it. It's a small firm. It's a firm that's growing quickly, and he wanted to add a new interesting strategy for his clients. So it was a very good fit. It gave us our chance to get started in the industry, which was fairly unusual for two young guys with no, I guess, professional experience. So the way we started initially, the fund was started under Rivemont. The portfolio manager was Rivemont's portfolio manager, and we were hired as external consultants. So I would write research reports and recommend my best investment ideas to Rivemont, and then Rivemont would implement the strategy. Basically, it was based on what I would recommend, but it was kind of their strategy, if you will. And then I studied for the CFA, got my CFA charter during these first few years of launching the fund. And in 2021, I joined Rivemont as an employee and became portfolio manager of the strategy. So
That's an inspiring story, and I just love how you went about it, right? And a former poker player, right? And so someone who you met on the circuit, you saw on the circuit. It's just awesome. Who did you count as your first early investors in the Microcap Fund?
So there were a lot of our poker buddies at first, because they had the same problem as me. Like they had savings to invest. They are comfortable taking risks. They're very comfortable with the volatility. So those guys were they had the best profile for a strategy like ours. And the rest was mostly friends and family. So we started with I think the first year we raised about 5 million, more or less. And over time the client base got diversified. Rivemont also put some of their clients' money into the fund, because Rivemont does private wealth management. So it's high net worth individuals who are looking for stock and bond portfolio, typically about 10 stocks, mostly large caps. And most of the clients have an allocation to some of our alternative strategies, like the Microcap Fund. There's also a crypto fund, and there's a long short hedge fund. So So over time, some of the clients invested a portion of their portfolio as well. So now we have a pretty diversified client base. And we have about 12 million in assets under management.
That's a big change, though, that many people don't appreciate, going from a consultant or an analyst to portfolio manager. That is a huge step. What new challenges were introduced into your working life as a portfolio manager versus the consultant?
Yeah, well, I would say there are quite a few differences, but for me, like I think my profile personally was more of an analyst. I like to work at my computer, like no distraction, just doing my thing, looking at financial statements, building models in Excel. That's my thing. I love numbers. When I became portfolio manager and we hired an analyst to kind of do my previous job, so first I had to train him. But once he became operational, he couldn't, he was good at building the models and all that stuff. Now I had to refocus my priorities into more of the high-level stuff, which was a kind of a hard transition at first, I would say, because now it's more, talking to clients and managing clients' expectations and emotions, which can be tough sometimes. It's also being the face of the strategy, the public-facing activities, marketing, speaking on podcasts, interviews, things like that, doing some business development. And I do also more of the, high-level stuff. Like I view myself as like the top of the funnel in terms of fundamental research. I screen the market every day. Maybe
You
we'll
set
get
the strategy, right? It's your discipline, it's your principles that set the top of the funnel.
Yeah, exactly. So I dictate basically what kind of opportunities we should look at. I try to speak with a lot of people in my network to see what they like, they don't like. So I try to bring in as many opportunities as possible in the funnel, and then Philip, my analyst, he does the really the research work to see if we're gonna invest in something or not.
Well, you're doing a fine job. When I think about microcap funds in Canada, you're the first person that I think of, right? And we've been in touch for a while. So kudos to you. Let's reflect, Mathieu, on the year that's almost wrapping up here, 2024. What was the year like for microcaps? Do you see a sentiment change here? What were your biggest winners? Let's reflect on the year.
Yeah, it was. It was a phenomenal year, that's for sure. Maybe I can take a step back and walk you through, the environment over the last few years.
Yeah.
Because if you look at large caps, there was a pullback in 2022, but for the most part, it's been like a bull market since the last 14 years or so. If you look at microcaps in Canada, the market really peaked in February of 2021. Everything was egregiously overvalued. There were a lot of IPOs, RTOs of very, very speculative companies, and it was so easy to raise capital. It was pretty crazy. There was an euphoria in the market. And then it started to decline, but it declined pretty significantly over the decline lasted almost 3 years. So the bottom was in November 2023. And over that period, if you look at the TSX Venture Index, it declined about 50%. So it's been a very, very challenging market. For us, it was similar. The drawdown over those 3 years was about 50% for the fund. And we started 2024, valuations were like the cheapest I had ever seen in 10 years plus of investing. You could literally find like good quality growth companies with a good balance sheet trading at anywhere from 5 to 10 times profits.
It was like a kid being in a candy store, right? I think a lot of investors during that time, that big drawdown that they described, 2001 through 2023, hung up their hats. They gave up on microcaps, didn't they? And for someone like you thought, okay, this is my chance. This is where I make the bold bets. If I have conviction,
Yeah.
This is where I can start backing up the truck, right? Because the valuations are so low. And when will I get this opportunity again?
Yeah, no, exactly. And so what I did over those years, we started when let's say the bear market started, we had a little over 30 positions in the portfolio. And over those next 3 years, I got it down to about 15 to 18 names. So I cut the portfolio in half in terms of number of positions. So I just concentrated into my best ideas, the cheapest, the higher quality names, and then I just waited, because it was like almost impossible to raise capital. Like, you have a 3-year bear market, the returns look very unappealing at the bottom. I think our compound annual return was like 5% for risky microcap strategy. Like, nobody would touch that. So it was impossible to raise capital. So no new capital to deploy. So I was just basically fully invested and just waiting for the market to turn. And the turning point, I would say, was when private equity firms started to acquire microcap companies. In mid-2023, you started to see all these takeouts of Canadian microcap companies. It wasn't just U.S. private equity firms, but for the most part, these were the buyers. And I think because the private equity space, there's so much dry powder right now, so they have a lot of capital to deploy. The foreign exchange rate of a U.S. buyer looking at Canada, like it's super attractive right now, and the valuations were just like extremely cheap. So you started to see all these takeouts, and that kind of put a floor on valuations. And then when all that capital started entering the market, a company gets bought out, the shareholders get cash, they try to redeploy the cash into similar opportunities. So it lifts all the remaining public companies up a little bit, and then you get more and more takeouts. So I think in total we had about 30 takeouts in 12 to 18 months. And it really helped the market to turn. So this year it's been a phenomenal market. Our fund is up as of yesterday, December 10. The Series A of the fund is up 92% year to date.
Wow,
Yeah.
92.
Yep.
Phenomenal, Mathieu. Congratulations. And it's true, private equity was a backstop, and it was a turning point. And I still see tides are turning, right? I think retail investors, into 2025, as the overnight rate in Canada, interest rates come down. I think that's another factor that goes into perhaps a returning retail investor now, supporting and buying into these microcap companies. You do a fantastic job of tracking all these takeouts in your newsletter, so that's a plug for you, for people to sign up, completely free, right? Stocks and Stones on Substack.
Yep.
I love it. As soon as I receive an issue from you, I open it immediately. I drop everything I'm doing, because you just do such a good job of covering companies in the microcap space. So around 30 companies were taken out, right? 2023 was a big year, and even into the first half of this year. Which ones that you held were taken out in the portfolio?
Yeah, so we had 3 portfolio companies who got acquired this year. One was Media Valley, a software company. Actually, the 3 were in the technology sectors: Media Valley, OneSoft Solutions, and the third one was GiveX. We didn't own shares, but we owned warrants because we had participated in the previous financing. So yeah, those takeouts were good for us. Because you get the premium right away, but at the same time, those were companies that I thought had a very long runway for growth. They were very high quality, so I was pretty disappointed because now I have to replace them with something else, and it's probably going to be something else that's less quality or less cheap, I guess. So yeah, it's bittersweet, but it turned out okay.
It's absolutely bittersweet. a little bit of attribution analysis. If you were to look at, let's say, what drove most of those gains so far year to date, 92% overall, are there a handful of stocks, I assume, that have driven the majority of those gains?
Yes and no. I mean, yes, we had a few big winners. I have some stats I can share with you, but it was the whole portfolio. So we had one stock. Our biggest winner was up over 300%. We had two stocks that were up over 200%. Two stocks that were up over 150%. So like 5 stocks were essentially multi-baggers this year, out of 15 to 18. So that's a good batting average. And I also looked at our largest loser for the year, and it was one of our large positions to start the year. It declined 10%, and so the impact for the fund was less than 1%. Less than 1% negative. So essentially no large losers at all in the portfolio. That's pretty crazy. Like, that's why I say it's a phenomenal year. Like, everything was up across the board. It was crazy.
And what were those 5 winning stocks this year?
Well, since we own a concentrated portfolio, I don't want to share all the names that we own. We gotta keep a few things secret, our secret sauce. But I'm okay sharing. Like, the biggest winner for us was Kraken Robotics, PNG on the TSX Venture. The setup was one of the best I have seen in my career. If you go back to sometimes in, I think, middle of 2023, basically the company, they sell equipment that goes into underwater drones. Predominantly this goes for military applications, but they also do some offshore inspection work for, like, offshore wind farms, for example. So they sell sonars and batteries that go on these drones. And the company's been executing almost flawlessly for the last 5-6 years. We've owned the stock since 2018. And they've grown revenue per share at about a 40% CAGR over that time frame. They're profitable. They have not the best balance sheet, but they have a good balance sheet, no debt. I like the management team. I've known them for a while. And what happened is that the founder and CEO decided to retire in early 2023. And he owned like 10% of the stock. And he decided, for whatever reason, I haven't spoken to him, but he decided to enjoy his wealth and just dump the stock in the market.
Everything, the whole 10% stake.
Everything. So I spoke to some brokers in Canada that were involved in the stock, and apparently some people offered him to buy a block of stock from him, but he just decided to relentlessly sell in the market. I don't know why, but that's what happened.
Wouldn't that typically be a red flag for you, Mathieu, when you see the founder and CEO just dumping all the stock and just taking off to the beach?
Yeah, well, at the time it was like, you're in the moment, the stock is dropping. So the stock starts the year 2023 about 65 cents, and it drops down to 35 cents. Almost exclusively based on his selling.
Yeah.
And so I look at this, you look at the numbers, you look at their sales pipeline, their backlog, everything's fine. I speak with the current management team. There's basically the CFO became CEO, a guy I've known for several years. Speak to him, everything's fine, business is fine, like we don't understand why he's selling, all that stuff. So I can't find a reason why he's selling. I'm like, is there something that only he knows?
Because your spidey senses are going back, right? Because that's usually that's a big red flag usually.
Yeah, no, it's a big red flag for sure. But at the same time, like, I do my research, I speak to several people, like everybody that I know that follows the stock is trying to find out why. Nobody can find an explanation. So at the end of the day, I'm like, well, I've done everything I could to try to find why he's selling. I can't find it. Maybe he's just like he wants to retire, he wants to buy a new house, a new car, I don't know. He wants to get out, that's it. Maybe there's nothing more than that. So I bought more stock at that point, around 35 cents, and made it a big position in the fund.
So you gained more conviction as a result. Is that because of the CFO? You saw in the CFO that they can continue, they can execute. This is really in good hands.
Yeah, exactly. And look, the setup was you have a company that's growing 40% a year. They have strong visibility over the next 12 months as well. They have guidance out there. Their backlog is full. They're profitable. They don't need to raise capital, and it's trading at 5 times EBITDA. Like you just never see that. So there was a structural reason the founder was selling an illiquid stock and was just like caused almost 50% drawdown on the stock for no fundamental reason. And it turned out that there was nothing more than that. It was just like he was selling, nothing was wrong. And so the stock started to rebound. After he was done selling, the stock started to go up pretty quickly because basically he was the only seller almost on the way down. So almost no sellers on the way up either. So the stock rebounded pretty aggressively. And then you had another strategic investor called Ocean Infinity. They're a player in this space. They're a Kraken customer. They had invested a few years before. They had bought about 10% of the stock in a private placement, and they decided to sell as well. So then, another potential red flag, and the block was bought by a handful of sophisticated long-term institutions in Canada, long-term fundamental investors. And then the company just kept executing. They announced new contracts, they developed new partnerships in their industry, they kept growing their guidance, they put out even stronger guidance for 2024, and the stock just ripped basically. It started 2024 at 65 cents. It's now $2.70, something like that. So
and what's the catalyst for the latest leg of price performance here? Is this the fact that retail is coming in? Was it a really blowout exceptional quarter?
So I think there are two things. The first one is what I call the discovery process. So my goal, maybe that, let's tie it back a little bit to some of my, a bit about my process to find ideas. If you find something that's below 100 million in market cap and it's doing well, it's performing, it's growing, at some point retail investors will bid the stock up to over 100 million in market cap, and that's typically kind of the threshold where I see some smaller institutions get involved with some of these microcap companies, and then you get more at 200 million, 300 million. So you unlock new pools of capital that can invest in your stock as you grow the market cap. And so it's a matter of hitting that first milestone, 100 million market cap. Then you get maybe one or two analysts that start to cover the stock. They introduce the company to a few institutional investors, and then the institutional investors talk to other institutional investors, and then the discovery process happens. You get better trading liquidity, better trading volume, which enables more buyer to look at the stock because it's more liquid. So it becomes a positive flywheel. So when we found Kraken initially, it was 20 million market cap, and it was barely trading any significant volume. Now it's 700 million market cap. It's trading, millions of dollars in volume per day. So that discovery process happened over time on Kraken, and now I think you're just seeing more institutional investors discovering it and buying stock. The other thing fundamentally that's happening is I'm not sure if you heard of a company called Anduril Industries. It was it was founded by Palmer Luckey, the former founder of Oculus, the VR headset that was sold to
Yes, that's
Facebook.
sold to Facebook. Yeah.
Yeah, exactly. So if he started a new startup a few years ago called Enduril to address to develop new technologies to sell into the defense market. And his thesis basically is that you have a handful of large defense contractors that are not innovating right now, and they are charging very high prices for what they sell. And he's trying to disrupt that industry by bringing newer technologies, using more software, more AI, to make basically the U.S. Army or other NATO armies more efficient for less dollar. And his startup is doing super well. It's growing quickly. It recently got financed at $15 billion valuation. It's private, and it's one of Kraken's largest customers because they build these underwater drones, extra large underwater drones, and they require Kraken batteries and some sonars as well, but predominantly batteries to go into these underwater vehicles. So if you look at the growth trajectory of Enduril, I think Kraken will benefit a lot from that growth trajectory. And if let's say you're an institutional investor, you want to get exposure to Enduril in some ways. It's private, you can't invest in it. What's the next best thing you can do? Invest in Kraken. So it's almost becoming like a proxy to play Enduril. So I think that's the other reason why you're seeing that kind of move in the stock price right now.
So as a former poker player, you're a betting man. If you were to place a bet, is Kraken a takeover target, or are there buyers eyeing the company, or do you think this will go on as a public company for years to come?
I think at some point it will become an acquisition target. It's always hard to tell. And I did some research on Enduril because in my opinion they were the most likely buyer. But their acquisition history has been more about buying new platforms. So, for example, they bought an underwater drone platform, and they're looking to integrate that with software. Kraken is like a component to that platform. So I'm not sure they haven't had a history of buying some of the components that go into their main platforms. So I'm not sure if Enduril is the likely buyer at this point, but the batteries are fairly unique. They have a process. I don't want to go into the weeds too much, but basically the way they build the batteries to go underwater, like if you go very deep underwater, there's so much pressure that you need to encapsulate the batteries into something that compensates for the pressure. And Kraken has a very unique way to do it. And they can basically enable these underwater drones to have twice as much energy for the same footprint. So the missions can go twice longer with the same amount of batteries. So it's a huge competitive advantage. They are far ahead of their competitors. And they're not only working with Enduril, they're working with other OEMs that are developing these large platforms as well. So at some point, I feel like maybe one of these guys will want to get their hands on the technology to make sure their competitors don't have it. Who knows if it will happen, but that's the way I would see it playing out over time.
And this is patented technology that Kraken owns.
Yeah.
Okay. I can only assume with performance like that, that it's now your largest holding by weight, Kraken Robotics.
It's not, because I trimmed it a little bit to for risk management basically, but it's still up there. It's in our, like, the top 5 positions in my fund is represent about 60% of the assets, so it's fairly very concentrated. And Kraken is in the top 5. It's one of the largest, but given that the stock has done so well and the valuation now, it's hard to make a case that it's cheap anymore. So my rule typically is never bet against a company that's executing, and they've been executing flawlessly. So that's why I want to keep owning it. But position sizing is key here, I think.
The company that didn't work out this year, can you name the company? Can you talk about some of the lessons learned? Like why it didn't meet expectations?
Yeah, it's a company called Microbix Biosystems, MBX on the TSX. It's a small life science company based in Mississauga, Ontario. And historically, this company, they've been in business for 30 years. They manufacture antigens that go into diagnostic tests. So, for example, I'll give you the simplest example. When COVID was happening, you take a COVID test, a rapid COVID test. The ingredient in the test is called an antigen. That's what will react to the virus if you have it. So all the diagnostic tests for all different diseases, they use antigens. And Microbix sells specific antigens for specific types of tests. So they sell the ingredient in the test. It's a very, very critical component of a test, but fairly inexpensive in the grand scheme of things. So they have some pricing power, and they have some niche areas where they are kind of the market leader. So it's a decent business. It's not growing super quickly, maybe 10% a year. What happened a few years ago? A new CEO came in, and he looked at this business and he said, we have this specific expertise. How can we expand, develop new products, tackle new areas of the market where we can leverage that expertise? So a few years ago, they started developing quality assurance products. If you look at the diagnostic market, historically, you go to the doctor, they give you a test, they send it to the lab, and you get the result a few days later.
Mm-hmm.
The market has been moving to point-of-care testing, meaning you have a device in the doctor's office, you do the test, the doctor puts it in the machine, 20 minutes later you get your result. So there are a lot of new point-of-care instruments that have been hitting the market in the last few years. And the regulations for these types of devices is that you need to have a quality control system in place to make sure the device is well calibrated. So you want to make sure basically that if the machine doesn't work, the doctor doesn't give false results to like thousands of patients. They need to check every, let's say, 20 tests. They input a known positive, known negative in the machine, and if it spits out the right result, the machine's working properly. So Microbix started to develop these quality assurance products that go into OEM devices. And they signed a large diagnostic company as a client a few years ago. So basically, the client will sell the machines, sell the test cartridges to the doctors, and each cartridge will come with a Microbix quality assurance products in the box. So it's kind of it's almost recurring like revenue. As long as people get tested, Microbix controls will keep being used. The issue now where things went wrong basically is that this large customer had a lot of regulatory delays to get their instrument approved by the FDA and get it to market.
Mm-hmm.
And they were developing their first test panel was for respiratory viruses. So once they got delayed beyond like the winter, they had to wait another year to bring it to market.
Mm-hmm.
So it was almost, I would say, 2 years of delays with that customer, which was kind of the main growth opportunity. I mean, they're working with other customers. They're trying to embed themselves with other tests as well, but that was the main one for the last couple of years, which didn't pan out. So I mean, you look at the company right now, it's still growing, not as quickly as I would have expected. They're profitable. They have cash on the balance sheet, no debt. They're buying back their stock. I still think the long-term thesis is intact, but it's taking longer than expected. I think a lot of people threw in the towel at some point. I didn't, but
And that's the lesson, right? I think viewers need to take away from this is that sometimes the best thing to do is just wait, right? If your thesis is intact, the business is growing, nothing's changed since your initial position, then that's probably the best action, right?
yeah, but it tests your conviction at the same time because you have to wait 2 years for no returns or actually negative returns, and you're like, is this gonna happen or not? So,
walk us through, Mathieu, a recent stock selection, stock you added to the fund, just for us to get to better understand your process, top of the funnel to the bottom.
yeah, well, like the bread and butter, I would say, is buying companies like MicroCaps or Kraken Robotics that are. I'm shareholder of both still, by the way. Companies that are growing or at least have growth expectations. They're profitable. They have a good balance sheet, good management team. They have defensible competitive advantages. So that's kind of the bread and butter. And the secret sauce, I would say, is that I find them very early when nobody cares. So typically below 100 million market cap. How I filter the market is I skim through all the press releases on the Canadian market every day. So
okay, and you go to the new CDAR website for that, I assume, right?
No, I don't. It's so painful to use CDAR, so I use StockWatch.
StockWatch, okay, so you've subscriber to StockWatch. Do you miss the old CDAR?
Yeah, I do.
Yeah, same here. It was an antique of a website, but it just worked, right?
Yeah.
Everything was on one screen. You scroll through. Now you have to fill out the text boxes and search and filter.
Yeah. It's crazy that they were able to get a new platform out that was worse than the previous one, but they did. So
they did. They were successful in making it worse. Exactly. So you said, okay, I want to go back to the old way. Subscribe to StockWatch. And the universe is vast. In your newsletter today, you basically stated, hey, listen, the public market in Canada, the stock market, is basically a microcap market. Like 85% of companies are microcaps trading under 300 million, right? And so there's a lot of press releases to go through, but I'm sure you've been through all of them already once. So you have a watch list and you know what to keep track of, and you're looking for catalysts and turnaround opportunities, I'm sure, and companies that maybe were unprofitable that have turned into the black and are profitable. So how do you manage that bench and that watch list? I'm curious. And tell me what you look for, and you say, okay, this is the time to pull the trigger.
Yeah, so it's between 200 and 1,000 filings per day to look at. But I look at the headlines, or if there's a financial statement, I open it. I look for the same criteria I mentioned at the beginning. Profitability. I look at the balance sheet. Just based on those two criteria, I can pass in 10 seconds for most opportunities. When I find something that looks decent, maybe they have some net cash, they are growing a little bit, they are maybe profitable or close to profitability, then I'll dig a little bit more. I'll look at what is the company about, what's their business model, in which industry. I'll read maybe a couple press releases, and if it looks like something that generally has the attributes that could fit our portfolio, then I send it to my analyst for further research. And then, some of these companies, maybe they don't have enough track record. Maybe they had 1 quarter of profitability, but we're unsure if they're gonna be sustainably profitable, or maybe they've grown, but it was like one large customer, and we don't know how it will evolve. So we start watching these companies. So I add them to my watch list to receive the press releases in real time, and we start to follow them. In some cases, we reach out to management. We take a call with management to try to understand the business
which is crucial, right? Like when you're investing in small companies, it's crucial to talk with management. Tell me about some of the questions that you ask CEOs.
Well, usually a lot of the questions we ask are about the competitive landscape. Who are their competitors? How are they different or better? And what's the moat? Whether do you have patents? Do you have trade secrets? Like what's unique? And a lot of companies, unfortunately, they don't have anything unique. They sell something that's undifferentiated. So a lot of companies don't make it past our first intro call with management because we feel like there's nothing there that's substantial. But the companies that we think have something unique and did some of our financial criteria, then we start to follow them more actively. Maybe we do a few more calls with management. Maybe we try to dig. Basically, the goal is to know these companies better than most people. So if we need to speak with maybe a customer or a supplier or an industry expert, I mean, not always. It's not always required, but if we feel like we need to, we will do it to get the level of understanding that we need, and then basically it becomes about valuation. So if we think it's a quality company, quality management team, then it's just about paying the right price for it. So sometimes we can be, very patient. We can wait for years before buying something because it just doesn't hit our price.
Yeah, so a lot of it comes down to competitive advantage, and a durable one, and then can they scale? And if they do scale, will it be profitable growth, right, going forward, and not dilution and all that can sink some companies. If you look at your fund now, are there companies, and I would imagine that Kraken might be one that since day one you've still held?
Yeah, Kraken is one. There are a few actually. If I look at our top 5 holdings, let me take a quick peek. So there are actually, I think 4 out of 5 that we've held since 2018, and that's kind of the key here. Since we run a concentrated strategy, like I don't buy 10% of the fund into a single stock right away on day one. It's never happens. So what I do is I start with the starter position, typically 1 to 3% of the portfolio, and I look at the execution for a few quarters. Did management do what they said they would do, and are the financial results tracking according to my expectations? If everything is working as I expected, then I increase it over time. And typically, these stocks tend to do well. Also, if they execute, typically the stock goes up, so it increases as a percentage of the portfolio by itself. But then I buy more until it becomes 10% position or 15% position. So that's why if you look at our top 5, these are companies that we've held for 5+ years.
And you're building conviction in those companies over time.
And I trust the management team. That's when I would say the difference. Like we own some great businesses that are small positions in the fund right now, and we own great businesses that are large positions. The main difference, I would say, is my ability to trust management.
Yep. Now, let's leave the takeovers out of this because takeovers are takeovers. What's the company, and there's a lesson here, I'm sure, that you held for the shortest amount of time in the fund?
I don't recall a specific one, but I would say it's probably a few weeks to a few months. I don't know. When I buy something, my expectation is always to keep it long term. As you can see, our top 5 we've held for 5+ years. But the thing is that most microcaps will not execute as expected. So that's why I go with the approach of buying a starter position, watching a few quarters. A lot of companies, I watch a few quarters, I'm disappointed, I sell. So there's a lot of turnover in the small positions. Sometimes literally I buy something and then management does something stupid the next month and I'm out.
So what makes a really good CEO then? Like an individual who doesn't make any stupid mistakes. Like, tell me about the qualities and the decision making.
Yeah, well, I think that it boils down to a few things. Thinking long term is one. I like someone who's not promotional. So, when a CEO talks a lot about the stock price, that's a big red flag to me.
Mm-hmm.
I want a management team that doesn't really care about the short-term stock price. They care about improving the business for the long term. And then, someone who under-promises and over-delivers. A lot of microcap CEOs tend to over-promise. So when I meet someone, they say they're going to do something, they exceed it a few months later, that's a sign to me that they're the real deal.
Let's look out to 2025. What's your outlook for the microcap market? And in your newsletter and also on X.com, if people follow you, every month you do post new stats from the TSX Venture Exchange showing volume and dollars coming in to the Venture Exchange. And year over year, there is significant material growth coming in. Do you see that picking up in 2025?
Yeah, so that's an interesting, great question. I started following about a little bit over a year ago the TSX Venture statistics, mainly on two different metrics. The first one is the trading volume in dollar, so they call it value traded, and the second one is financing volume, so the amount of financings that are raised by TSX Venture listed companies. To me, these are indicators of where we are in the cycle and the health of the market. If you have a lot of trading volume and a lot of financing, that means there's a lot of activity. People are willing to invest in microcap companies. If there's low volume, the unprofitable companies can finance themselves. A lot of them go out of business. It's not a thriving ecosystem. And for the investors that are buying or selling in the market, if there's no volume, it's not attractive to deploy more capital in that space. Now, I told you about the downturn from 2021 to 2023. If you look at the data in 2023, on both fronts, it was about 40% below the long-term average. I look at the 15-year average.
Wow.
40% below. The 2024 started about the same. Even lower. In the first few months of the year, it was even down year over year compared to 2023. But it started creeping back up in the last half of the year. Now we're back to almost 2023 levels. And even if you take the November data, October and November data were pretty strong in both areas. If you annualize those financing and trading volumes, you're still about 25% below historical averages. So there's still a long way to go just to get back to average. So even though, like, I look at the companies we own, for example, several stocks up over 100%, but the market is still not even back to average in terms of liquidity. That's pretty crazy when you think about it. And valuations are not that expensive, Like if you look at stocks that were trading at 5 times EBITDA, they doubled, they're at 10 times, they're still not expensive by any means. So I still think that, like the market, typically it's a pendulum, it swings from undervalued to overvalued to undervalued. These are the cycles. Rarely you see a market that goes from undervalued to fair value. It stops there. It's a pendulum. It swings. So I think right now we started the year extremely undervalued. Now it's swung this year, I would say, to probably fair value in that neighborhood. And my expectation is that it will keep swinging the other way. So we'll see even better trading, liquidity, financing volumes, valuations will continue to expand from here.
Yeah, and in microcaps, the pendulum can swing up faster than people think.
Wildly,
right?
yeah.
Yes.
Yeah. So I don't have a crystal ball, but if I look at the trajectory right now, I think we're set up for another strong year in 2025. But we'll see.
What are the best ideas, your top stocks that you have the most conviction in going into 2025?
Yeah, well, it's always hard to make like a 1 year prediction because my stocks typically tend to not work on those expected timelines, like the microbics, for example. But if I look at the next few years, my favorite idea at current price would be a company called BQE Water, BQE on the TSX Venture. This is thinly traded, so be careful if anybody's going to look at that company. But the thesis is BQE is they provide water treatment systems and services for mining companies. So if you have a mine that's in production, it typically uses a lot of water to do the actual mining, and that water gets contaminated by some metals, and it gets released into the rivers, and it creates a lot of pollution. So there are stricter and stricter regulations around the discharge of water in mining projects for new projects that are coming online. And BQE has developed specific technologies that are patented to address some of the more difficult to remove metals in the water. So they have some fairly unique technologies. They don't apply to all mining projects, but when a mine has a specific problem for a specific metal, sometimes BQE is the only game in town. So they are able to. So to me, that's the moat. They have unique technologies that apply to a specific niche of the market. It's a small niche, but hopefully it expands over time as regulations get stricter everywhere. And they're also developing new technologies for other use cases. The business model is fairly interesting. If you look at the timeline to develop a mine, it takes several years just to get the permit. So the permitting process, when the mining company is doing the permitting, they have to submit a plan to treat water. So they hire BQE as an engineering consultant to design the water treatment system. And once it's kind of spec'd in to the project and submitted to the regulators, the mining company essentially has no choice but to keep it that way. So it's embedded in the project. So they get these technical services up front. And then once the mine goes into construction and production, BQE will operate the water treatment plant for the life of the mine. So you have, in some cases, 20 years, upwards of 20 years of recurring revenues for a system that's been spec'd in, 25 years ago. And they have a project with Glencore in northern Quebec where they've been there for 20 years. So it's like it's not pie in the sky, it's real. And so their goal is to bring new projects online, like 2, 3, maybe 4 new projects per year online. But every project, on average, generates about $1.6 million of recurring revenue per year for
20 plus years, possibly.
Yeah, exactly. So they stack these high margin recurring revenues on top of each other every year. So if you look a few years ago, it was predominantly services that they were selling, but now they're stacking these recurring revenue contracts and building that up. And they've grown at 35% CAGR the last 3 years. Highly profitable. They have 11 million of cash on the balance sheet, no debt. Great management team, a moat, and the valuation is still attractive. I mean, the stock's done well this year, but it's still trading. If I look at my 2025 forecast, I estimate the stock is trading at about 11 to 12 times profits. So, for a company with that kind of growth profile, I don't think it's expensive at all. So but the caveat to all this great thesis is that it's seasonal and it's lumpy. The technical services can be lumpy from one quarter to the other, and the water volume that they treat can also be seasonal because some mines are closed during the winter. So you gotta take that into consideration when you look at the opportunity, but because not all quarters will be up and to the right.
Yeah, of course, and obviously viewers have to conduct their own due diligence, right, on any of these companies. If you were to maybe talk about some other good best ideas, Matthew, we'd love to hear them.
Well, I think actually, I said I didn't want to disclose too many of my positions, but you actually got me to talk one by one about almost all of them. So good work on that, Robin.
All right.
No,
So I
but
guess mission successful.
yeah. Well, no, honestly, I think like the main positions we own. I think I kind of discussed them already. Maybe one thing I just to give you something to answer your question. I won't name a specific company, but one area of the market that I've been looking at lately that I think is interesting is the cannabis space in Canada.
That's Contrarian, isn't it? Because
Yeah.
that basically blew up, right? In was it 2018? And I don't know a lot of investors who even want to touch the space currently. So tell me about that.
Yeah, exactly. So we had a huge bubble in Canadian cannabis several years ago. Personally, I never invested in a cannabis stock before 2024. So I didn't touch the space on the way up, on the way down. But now, the last few years, what happened is that there was a lot of oversupply, that a lot of overcapacity was built during the boom, and it put a lot of downward pressure on the price, the price of cannabis over the last few years. It's a commodity. So the pricing environment has been so challenging, and especially with the excise tax regime we have in Canada, the excise tax is really expensive because there's the way it works is the price that you sell the cannabis per gram, it's either 25% of the selling price or $1, and it's the highest of the two. So now I think cannabis is selling for about $4 currently. So the excise tax is $1 instead of 25%. So no, sorry, I messed up the numbers. It's 10% or $1.
Okay.
But now with the price at $4 a gram, the $1 is 25% instead of 10. So that's the mix-up. Sorry. So the excise tax in percentage is so high right now that it's challenging for anybody in the industry to be profitable.
So there's a high barrier to entry, so there's less competition.
Yeah, so a lot of companies are going out of business. We've seen several bankruptcies, a lot of consolidation. The companies that are struggling are selling to the stronger players.
Yeah.
And now it seems like the industry is starting to normalize a little bit. And the reason why I'm interested in the space, obviously it's very contrarian, valuations are low, but you can still find a handful of opportunities where a company is still at these levels, in this pricing environment, still profitable and growing. And some of them are trading for basically book value. So like the replacement value of their land, they're trading at that valuation, and they're profitable and growing. So the valuations are just super cheap because the space is so overlooked. And for a reason, because there are a lot of bad companies as well. But if you do the work and find the good ones, I think it's an attractive industry to look at. So I spent a lot of time looking at that industry lately.
Have you pulled the trigger on any cannabis company since?
Yeah, so we own three cannabis companies right now, small positions. They're at the stage where I'm looking for the execution before deciding what to do with them. But so far, they've been tracking according to expectations, so that's been promising.
Are these three all growers, or are there some retailers mixed in?
There's a grower, and basically they're vertically integrated. They sell products as well. There's one that sells only products, and the other is a retailer. So all parts of the value chain.
Okay, so we'll stop there without naming names, of course. So looking back on our conversation, Mathieu, and hearing, from some other investors and portfolio managers, some make the argument that you can't create a portfolio of just Canadian companies, right? You've done it though, not only a fund, a portfolio of Canadian companies, but microcap Canadian companies. So how do you argue back? What would be your rebuttal to someone who says, no, you have to diversify outside of Canada?
Yeah, well, I view my strategy as a component in someone's portfolio. I wouldn't recommend having 100% of your portfolio in Canadian microcaps, except like if like I do almost because I manage it myself and I know the space inside out. But for most people, I don't think it's reasonable to position your portfolio that way. So I think geographic diversification is probably appropriate for most people. But that said, if you look specifically at microcaps, I think there are enough opportunities in Canada to build a very decent portfolio. The um, the issue lately with all these takeouts is that the universe has shrunk a little bit, and the companies that have been taken out were, for the most part, I would say, the higher quality ones. And you don't see right now many new companies going public. So the universe has been shrinking. It's been getting more challenging to find high quality names, but it's such a large universe. 2,800 companies to look at. I mean, you can certainly find like 15 that are high quality, growing, profitable. Like
Yeah,
if
and there's always the turnaround stories, right? That they might not be profitable now, or they suffered a setback and they're
yeah.
they're not profitable. They'll get back to black. Do you expect to see more microcap IPOs next year?
I think so. I mean, if the financing environment keeps improving like it has over the last couple of months, yeah, I would expect so. The issue over the last few years was that it's not attractive to go public because the valuations are so low. Like most companies, even like lower quality companies could probably find financing at better terms in the private market.
Yeah.
But typically the public markets offer better valuations than private. So that's why companies want to go public, and we're starting to see the beginning of that. So yeah, I would expect more IPOs, and maybe in the later part of 2025 if we keep on going on that trajectory that we're on.
Do you use Gen AI, or more specifically ChatGPT, to support you in any way in stock research, or maybe summarizing quarterly reports, Matthew? Like,
I don't use it very much. I mean, I think I should use it more. I started experimenting a little bit, like someone's been helping me a little bit to explore some use cases for Gen AI in our investment process. So it's early stage, I would say. I don't use a lot of it. Um, the way I see it, just at a very high level, what I do is I try to, um, I view my investment strategy as a bit more art than science. Yes, I look at the numbers, I look at, financial criteria, but a lot of it also comes down to talking to the management team, understanding the competitive landscape, understanding their incentives, their motivations, the way they think about strategy, long term, short term, that kind of stuff. I think those are very hard to replicate by Gen AI. So I don't feel the urge to use Gen AI as much as maybe some people do in other parts of the market. But
yeah.
not to say that I overlook it. I think it's going to be part of the process eventually, but I feel like I have a bit more room to find the good use cases for it.
As we close out our conversation, I know you mentioned Howard Marks and his book, The Most Important Thing. If you were to pick one more book that was, pivotal to how you invest, how you think about the market, what would it be?
Well, actually, there are three books on the same topic that I really really enjoyed. all the books on competitive advantages. Because if I take a step back, when I started investing 10 years ago, for the first few years of my career, the main criteria for me was a good management team. That was like, if I have a good management team, I'm good. Like the rest is not irrelevant, but less relevant. How my thinking has changed over the last maybe 3-4 years is that I put a lot more emphasis on the quality of the company. I would say, if you ask me now, I think a great business with a moat is more important than a great management team. Of course, you want both, but if I had to choose, so the books that influenced me a lot over the last few years, there are three. There's the little book that builds wealth by Pat Dorsey. There's 7 Powers by Hamilton Elmer, and there's Quality Investing. I don't recall the name of there are 2 authors, but those are 3 great books on understanding moats, and I think it helped me a lot to become a better investor.
I love it. Well, this has been a really fun conversation, enlightening. Thank you, Mathieu. It's always good to catch up. Really appreciate the time.
Yeah, it was great. I really enjoyed the conversations. Thanks for having me, Robin.
Yeah, cheers.